Hi, everybody. Welcome to yet another Sunday with Stack Talk. With me today is my very close friend, Maxie Jose. Let me introduce Maxie to you. Some of you would be aware about him, know him. Maxie is an ex-army guy, having worked with Navy at young days of his life. That's something which adds my respect to Maxie. After his Navy stint, he went on to did an executive program with IML and had a corporate stint before coming back and starting his own investment advisory vertical. He is one of the few RIAs to start the vertical when the regulations around it started in 2013-14. With a decade of experience of asset allocation and advisory at his end, and more than 2 decades with his better half, they combine, bring a lot of knowledge on wealth management and advisory. Uh, they, it is very not at all surprising, rather, that they are one of the biggest advisors down south, and in fact, the biggest in Kerala. But that's not the credentials of Maxi. Maxi is a passionate investment advisor with brings a lot of knowledge around wealth and stuff. Me and Maxi were talking about the equity market, the volatility, the macro, and all that stuff. So I said, Maxi Live, why don't we record it for our future reference? So welcome, Maxi. Thanks for taking out for them. This, as you'd have seen with our previous Sunday talk, it will be a discussion between us and just getting it recorded so that in the future we can use it to see how foolish and or how intelligent we were back then.
Thank you, Mridul. Good evening. It's always a pleasure talking to you, and thanks for inviting me. And the good thing is, it's safe to be this side asking questions and not answering. Thanks, Mridul. Thanks again. Shall we dive straight into the session, or you have
Yes,
more instructions for?
I think let's dive into the session and not bore our audience.
Superb. So, if you actually look at it, last few months, uh, the there have been huge changes in globally. Elections in large part of the world, geopolitical complexities. You had interest rates cuts. You have downward inflation trends, and many more. So let's do one thing. Let's start with the most talked about global change, which could probably influence most parts of the world, the Trump factor. So let me start with what people think about Trump. Actually, Trump, for most parts of the world, brings in sort of uncertainty, fear to some extent. Though what I read and hear about Trump is in the US, people don't think him to be so reckless. So that's extremely important for you to understand that. Uh, he could be disruptive for the world with high tariffs. You could have more tax cut in US. Some of it could be inflationary. This could restrain Fed from cutting rates. Add to it, if you look at it, the US economy and you know the employment numbers look very strong. So it's probably would mean that interest rates could remain elevated for some more time, and we could see a stronger dollar. It could restrain other central banks, including RBI, from cutting rates. So there are a lot of factors which have come into mind. One other thought which comes to me is India going to be a beneficiary of a possible US-China trade war? Is it possible that India could find this as an opportunity and get the best out of it? Uh, but it's important again to understand, and it's my personal opinion, that Trump is a shrewd businessman and is known to be very transactional. With all this, which I've mentioned, what do you think it would mean to India and probably world at large? How would Trump impact all of us going ahead for next 4 years?
So Max, you have touched, I think, the epicenter of the matter which is other than finances, which will drive the financial market, and that is Trump. So I was doing a lot of reading even before the US elections because I had a view that Trump will come. My initial view was 8 years back that Trump is a disruptor, is a business mind, as you rightly said, and hence will be negative for the global trade and economy. In that 4 years, he did disruption. But if you look at it, he did it with one single objective to make the US economy strong again, which is very fair in a lot of ways. And obviously, the direct impact is was on China, and we saw the impact on Chinese economy because of it. I was more focused on what Trump was talking before he was ending term one, because it's very logical to think that he will continue with that. That's how I started thinking and reading. Couple of things got added over a period. One, lot of smart people who understand politics and who understand US politics in particular, they said that this Trump should be a refined version of the raw Trump which we saw in 1.0. Because that time he was not a politician, he got a power, a raw power for the first time. But in that 4 years, he has gained a lot of experience. And also, the post 4 years, he has seen what the Democrats have done. So I think the premise may remain the same, which is make US great again, but his actions could be slightly different. I
Mm.
believe it will be it will be less raw,
More rational, probably.
more rational, more diplomatic. That's the
Abs-
first. A sign of that is that even after becoming the president, winning the election, he is a lot more moderate, both in his speeches and social media,
Absolutely. Yes.
unlike the old Trump,
Yes.
right? Which you will not assign to the Trump. You will expect him to take enemies and critics to the races, but he has not done, which is a sign of maturity. Uh, I'm sure China will be a victim of this because of the continuation of 1.0 and the fact that a lot of global world believes that COVID happened because of China.
Hmm.
And trust me, the reason term didn't got re-elected was because of the anti-incumbency because of COVID. Re-election happened in the middle of COVID, if you remember. So he will come back on China. Why I think it is good, not only because it's the better of the two evils, because Democrats obviously didn't did any good to the global economy, is because the world was getting divided between two parts: US and allies versus Russia and allies, which is Russia, China, and allies. Now, the moment if this stretch continues, we were risking a World War III, to be honest, in a very silent zone,
Hmm.
because Hitler did the same thing. It was Hitler and his allies versus the world. So, because of his known closeness to Russia, I think there could be a middle ground.
Okay.
So that way, I'm happy that Trump has come, and I think he believes in more economic wars, which could mean higher trade tariffs and trade costs. But the tariffs and trade costs will come where you are making money. So what Trump says, and that's been very rational, that I don't want you to make super normal money at the cost of American. So if the trade rules are fair, it doesn't disturb, which is where I think India may do well. What immediate impact negative for India is a lot of talks may take time because he's a tough negotiator.
Yes. Yes.
And the second is Trump 1.0, while going out, spoke a lot about job losses because of Indian IT. So, which is where few months back when we came out with our note on IT, we called ourselves bearish on IT. And one of the factors we said is if Trump comes back and he revives his H1B visa cost and minimum employee or cost, salaries and stuff, it will hit the IT companies. I am not too worried about the exports part other than that. because India equally imports a lot from, and India is a tough negotiator now themselves than what we were 8 years back. So, which means that it will be a fair trade. And if I talk about fair trade, I think India is well positioned compared to China specifically. For whatever it is worth it, the fact remains that good for China is negative for India, and bad for China is good for India, because India competes with China on global trade in a lot of matters. And one of the matters where we compete is also asset allocation for the emerging markets or BRIC funds. So if it's negative for China, it's definitely good for liquidity into India. So from a financial market perspective, I see more positives than negative, is my first view. And from a earnings perspective, other than IT, I don't see much of an issue. If large companies continue to invest in India, or they give opportunity for US companies to invest into India. Sorry, if Indian companies invest into US and India allows US companies to invest into India, I think Trump will call it a fair trade.
Absolutely. I think, couldn't agree more with you. As I said, probably Trump would look at each individual uh, discussion with a very clear transactional, intent.
Yeah.
So absolutely. So I
And the other thing is, I'm sure he realizes that he can't make enemies everywhere.
yes,
So he
yes.
will, if he has to make enemy with China, he will look for a friend in India, and especially with his relationship with Mr. Modi.
So, I was just about to, bring that up, that two things, I don't think, correct me if I'm wrong, the tariffs were not as bad in the last 4 years, which people are talking about. Second, even his immigration policies, probably quality immigration would continue. He's
Yes.
probably going to, put a hold on to illegal immigration and the lower end of the immigration where the Americans lose their jobs. So that's my, opinion.
So the way I look at it is, a Trump is a very smart guy, right? So what he is looking for is, as we say, unplanned expenditure in our budget. Because US has a strong social security system, for every job loss, they pay money to the these immigrants also become eligible over a period of time.
Yes.
So he is looking at a long-sightedness, where if more jobs are created, the exchequer gets less to pay. And obviously one of the way to make money is also tariffs. That's what he believes, rather than taxing the rich, which is anyways there. If you look at what Biden was doing, he was doing more populism, which hits your economy over a period of time. So, and I agree with one part of your, that volatility may increase across the markets. I also agree with you that bond rates may remain high. So one thing which is very surprising is happening. Even though the Fed is cutting rates, the bond yields are continuing to go up,
Yes.
which clearly means that people are expecting more volatility and seeking safety. But that pertains to US economy and not the following is. So typically what used to happen is US bond rates going up leads to increase in G6 for India or other countries. This time it's not happening the same. Only the US bond yields are going up while other countries are relatively stable. So which means that there's a consensus among the investor group that US will see volatility in news flow and stuff because of the change in regime, and they are looking for a safety there.
Can I just take you a little more and try and introduce a little different perspective from from my
Yeah,
side?
sure.
You know, if you look at it, India is one of the most important strategic partners for the US outside NATO today. You
Yes.
know, you also must look at let's say Treasury Secretary who's Scott Bessent, who's been nominated now. He's also seen as a gradualist actually, so he would probably reduce the intensity of the tariff going up. He also supports low fiscal deficit and higher crude production. I think all these look extremely positive for India. You would also see probably, I'm just, because of Trump's unpredictability, you probably see the preemptively, you start seeing the geopolitical situation improving, in the Middle East and probably, Europe also.
Exactly the same thing we wrote in our newsletter, that we expect the global risk on to come over a period of time. Now his vice president is supposed to be a very hard worker, rational guy. So look
Yes.
at his team this time, right? As you rightly highlighted, his team this time is more forward looking rather than control looking. Unlike the previous Trump, he wanted control over the thing. This time his team seems to be more rational, and which is his behavior also.
So I think that's an interesting, thing to close on. Let's move on to the next thing. And I think it's been
Sure.
bothering Indian investors for some time now, at least for the last couple of months, is a sell-off by the FIIs. Today, probably the FII ownership is, decadal or probably more, 12, 13 years low at 16.5, 17%. After the Trump trade, after the elections, there are a lot of hot money which accelerated out of India and even out of the emerging markets into the US. Would you be concerned about the FII sell-offs, or you believe that the domestic investor would support the market and will, be protected from the reasonable downside?
So two parts. Let's break this, and I'll touch the middle part of your statement first, which is decade low FI only. The way I look at it is that that number is lower in percent because of the proportionate lower there into the Indian wealth system. One data point I was reading somewhere online a couple of days back, that fixed deposit to MF as a percentage to fixed deposit a decade was 5%. Today it is around 21%.
Right. Yeah,
So what
20%.
has happened is a lot of new money from the SIP perspective and non-SIP perspective have come into the market. The same money was not able to be matched by the FIA. So it's very natural that as a weightage, their weightage will come down. So let's not look at that percentage in isolation. If there are 100 rupees in the table, you contributed 20 rupees, so you had a 20% share. But over the period, other members came in and they contributed 20, 30 rupees more. You, for some reason, could not match it. So your percentage comes down. That doesn't mean that you are bearish. It only means that other aspects, like the retail, like the mutual fund,
Higher participation.
insurance, have increased their participation.
Yes.
And the second aspect is that lot more the companies have grown faster with because of this new money. In the last 5 years, Indian market, both in earnings and in market cap, has grown a lot. And hence the proportion of the benefit of the proportionate of this money is much more higher. In value terms, FIAs have
Hmm.
grossed down their investments into India. The bigger factor which worries me today is two factors, Maxi. One, we are painted a half picture. And I don't blame anybody, but in the world of social media and a quick news, nobody wants a deep dive.
Hmm.
Everybody wants a quick intake. So the print number of the FI is definitely high. But let's understand that this is a print number on a gross basis. Why it is gross basis? Because there's a lot of money which goes into IPOs and QIPs and pre-IPO, which are not part of this outflow. We need to subtract that to know the real outflow.
Okay.
That's the first part. I was reading a CLSA report which said that in the last 1 year, we saw a primary paper. When I say primary paper supply, it means QIPs, it includes blocks also, was 1.5% of India's GDP.
Yes.
Now that's literally 6 lakh crore. That's a huge number. And let's say if I was 25% of it and not more, then also 1.5 lakhs crores is gone there, which is what 30% of the all they have sold in last 12 months,
Hmm. Hmm.
right? So
Yes.
that brings a considerable number down. The second aspect, which I don't know how many of us realize, is there's a big book of FI, which we call the arbitrage book or the traders book. So there are two factors to it. One, there are lot many traders sitting in every part of the world, including India, who use the passive funds float and take an income out of it. There's a huge test with each bank back in Hong Kong when I was with MK more than 10 years ago. And each of them you had access to, like MSCI have a India index, right?
Yes.
Now, now there is a bank, let's say Barclays, for example. Barclays runs a MSCI index passive book, and they have investors who have to have put money. This shares don't get traded until as MSCI change the weight. So there are traders who use this float and some margin to make risk-free trades and algos around. What happens is when the NDF move, which is your hedging currency, or and when the interest rate or the bond yields move, their cost of trade moves. And because they are thin margin traders, every 10-15 bips movement in bond yields in US makes it tough for them to continue with the book. Over the last 3 to 6 months, we have seen slowly and steadily the bond yields in US are moving up in spite the interest rate coming down, which means that more and more unwinding in this book is happening. When the unwinding happens, they sell in the cash and they buy in the future or they let the future expire. But they can't let it expire anymore because of the physical delay. So either they let both expire, which means the FI holding, what you mentioned, keeps coming down and you see sell figure. One example, the last month expiry, November, that day the FI sell figure was 11,000 crore net sell figure. There was no need for such a number. There was no sell off. It was just that either they sold the arbitrage portion of it. And the second aspect is that a lot of money has gone into options trading, both in within India and outside India. So a lot of movement in the short term happen as the basis of the index basket and all that stuff. So looking at a cash sell figure in isolation doesn't give you the true picture. Added to that, over the last 2 months, the earnings were not good. The market texture both globally and in India was not great. India being underperformed, which means the hedge funds got an opportunity to be net short in India. They're trading short from hedge funds outside. That added to the sales. So there's something called hot money or quick money, and there's something called arbitrage risk-free money, and there's something called net long or long only money. My view is the third part of the money was not getting sold off. Yes, we
Understood.
didn't got the additional flow of it as you normally get because the earnings were weak. So it brings back to the same point which I always highlight at the cost of repetition, that everything revolves around earnings in the market.
Absolutely. I mean, that's what is going to decide where the markets are going to be.
Yeah.
Absolutely.
So don't go by the flashing numbers of FI sell on media and stuff. There are more than 2000 FIs in India and they have all have different strategies. It is very tough to decode the FI number, I can tell you that much.
It's good. I think so. So my worries on FI are completely, unfounded. I can see that.
It's not to the magnitude it's
I,
been
I understand.
published. Let me put it
Absolutely.
this way.
Yeah. So let me tell you a couple of things which I'm very excited about. One is Indian macros look very exciting. It couldn't have looked better.
Agreed.
Probably even micros look excellent. I would go to the extent of saying this government is particularly good at managing fiscal issues and very prudent. They're very well consolidating towards that 4.5% they're talking about for FY26. Uh, Something excites me more even than here is, they have actually trying to reduce the primary deficit, which could actually be a game changer. Otherwise, the focus on that primary deficit would be a very, very good thing. External situation looks great. The current account deficit is around 1.5, 1.2%. You have 650 odd billion of or forex, um, broader direction of inflation remains, within the RBI's comfort zone. Though I'm a little concerned about the last inflation print, which came at 6.2%. There's also a talk about it being a little sticky, and RBI itself was a little hawkish on inflation. But what worries me the most is there's a visible slowdown in the economy, which people talk about, and quarter two is obviously at 5.4%, much lower than what the RBI estimates were, or even the market expectations for that reason. RBI has actually rehashed the FY25, growth projections to, I think, 6.6%, if I recollect correctly. So let me be a devil's advocate and make it a little difficult for you. Though there are signs of, I think, rural growth, but urban consumption and growth has been a bit of a concern for everyone. Private capex has not been there for last 10 years. Do we depend on public spending in the next or the second half to push the growth, or do we see it to be a systemic slowdown and could sustain longer? Would you be actually worried about it?
So let me add some data points to it. So Maxi, one thing about me, which you very well know, and for the benefit of the audience, I give more importance to one step down data than the print data. Right. So let's do that first. And let me talk about corporate capex or the private capex. I think the opportunity there is huge and the direction is amazingly right. One example of corporate capex is capital goods. You look at the commentary of Larsen, ABB, Siemens, for that matter, Suzlon, or any of the major players, they are talking right after a very, very, very long.
Yes.
Their earnings growth. So one expect, which I look at from a demand perspective, is margin. All capital goods companies have improved their margin in the last 3 years. If the capex was missing, they don't have pricing power. They would be desperate for the orders. And this margin improvement has happened in spite of volatility in the commodity price, which means the ground level capex is there. Now, it's very easy to say that BHEL, Larsen would have got government orders, but I'm talking about the broader picture and not including only the government company. I'm not including only BEL, Larsen, and BHEL. I'm talking about the bigger private players also. A lot of it might be around defense, which has grown a lot. But that gives me the confidence that if the government spends, the capex mood changes a lot. I'm not worried about the capex from a structural perspective. A
Okay.
quarter here and there will always happen on the decision.
Okay.
Uh, the big difference between my understanding of the real 2 decades is that rural is consumption is more, you will be surprised, but is more planned and seasonal compared to urban, which is more impulsive in nature. The way it functions is rural is आज पैसा है तो मैं खर्चा करूँ, ठीक है, and which is why when the 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 season of rabi crop cutting or the kharif crop cutting comes, we see expenditure around it, right? So it's a rural has a pattern. Urban over a period of time has become more, I will say, impulsive in the nature, where the mood happens with what the commentary they see. For example, and I'm talking about individual examples like our stuff. You want to buy a new car. You are indifferent 6 months here and there, right? It's if everybody around you is delaying that, then you will say that okay, something is missing. Let's
Mm.
wait.
Mm.
Whereas everybody is buying a new car. Oh, that's a good car. I also need it. Let me do it now. So discretionary spend is very impulsive and hard policy, right? And inflation has hit urban consumption. That's let's accept that. So it's a mix of these two which has delayed the consumption.
Okay.
This quarter becomes very important for it because of the festive season, the marriage season. I expect if we directionally don't see improvement, then yes, I'll be worried. But my understanding is it's very impulsive. Last 4 years, the committee was economy is doing well, everything is well, we learned well. So people kept spending.
Hmm.
Last 3 to 4 months, the commentary has been mixed. So
The narrative
unwanted
changed.
delay happens. It's prudent spending, right?
Absolutely.
And we saw a lot more spending on tourism, probably buying of home and stuff, which would have delayed the smaller discretionary spend. That's the way I look at it. But yes, that's a missing piece which needs to work out for economy and markets to do well. I completely agree with that in part.
Interesting. So just taking you a little away from this discussion because we talked about so much about rural economy. I'm just thinking aloud. So we have around, if my numbers are correct, around 20 crore farmers today, who are involved in the agricultural profession. We probably will have to, government will have to try and bring it down to 5 crore, which is the optimum number for a country of our size, I understand. How do you think this is going to eventually change in long run? The way urban, spending patterns are concerned, or how would it influence the economy as on a larger scale?
So I think that can only happen not while policies will have to be there, but I think that will naturally happen as the economy grows. See, we are traditional people. The culture, physical assets give us more mental relief rather than the virtual or the
Virtual
financial
assets.
assets.
Yeah. Yeah.
Okay. Even today, and you are a
Sorry.
very experienced financial planner. If I ask you that I want to buy my first home for the shelter or invest it in equities, you will predominantly and very naturally and rightly say, let's try and buy the
Houses
house
is the
if we can
priority.
afford.
Yeah, absolutely.
That's the mentality, right? The agriculture income is because the farmer believes that I own the land. So they will migrate from agriculture to non-agriculture only when the income in non-agriculture is very high.
Option, it looks much better. Yeah.
Yes. That will happen only when the economy grows. So it's a transition which is very natural, where the opportunities are created, which is where we need large manufacturing setups, which is where we need the MNC and the private capex, so that there are more job creation, the economy grows fast, and there's enough income opportunity. The second part of it is the education part. I think what this government did started a few years back is Pakka Ghar for everybody and health insurance means that they will have disposable income to educate their kids. So I believe that 20 years from now, let's assume a generation to be 20
Yeah.
years, those kids of farmers will be well educated to understand the opportunity outside agriculture. And hence a shift will happen naturally. So it's a gradual process.
That's a gradual process. Yeah, absolutely understand it. So let me come to the, what what basically the bottom line is. I need to make money as an investor. I mean, that's the bottom line.
Yes.
Um, I see that you're extremely, extremely bullish. Okay. Now, this is despite a lot of uncertainties. You also see valuations at a premium to long-term averages. Market cap to GDP is at an all-time high, probably. I'm just giving you these data points, just to make it a little difficult for you to answer this. Okay.
Okay.
Uh, do we see going ahead over the next, 6 months, 1 year, excessive volatility, uh, or trouble for the investors, or the long wait is going to be very long for you to start making money? Um, how have you positioned your portfolio to probably ride these difficult times? So if you can tell us
Okay.
a little about, without getting into specific stocks, if you can tell
So
me.
I refrain from talking about the stocks when we
Correct.
are talking about macro
Ah,
because that makes it
absolutely.
biased.
Absolutely. So what
Yeah,
I'm saying is, however broadly positioned your stock. So don't, no, let's not talk
yeah,
about
yeah.
specific
So,
stock.
so let me tell you one thing, Maxi. Again, historically, we thought that volatility is negative or it leads to negative returns. That's not the case. Volatility means that there is a confusion. Even the confusion is low, the volatility is low, and the direction is either side, right? So, so I call it good volatility, and this volatility is because of the way the texture of the participants in the market have moved. Unfortunately, the proportion of those who want to make quick money, आज invest किया कल पैसा बनाना है, is has increased a lot,
Absolutely.
and hence even though something which looks apparent in 3 months, they don't want to play it today. They want to wait for it to play out. Right?
Mhm.
That actually, because everybody wants to do the same at the same. The second part where I conquer with you is that we are super ultra bullish, and this is because of earnings and the visibility in the. Yes, we are probably different from the street there. What I want to highlight here is that India has a $4 trillion GDP, right? Our budget would be $2 trillion. So which means government is 50% of the economy even today. Right?
Yes.
And because of elections, because of the delayed budget, you look at any of the macro parameters, which is government borrowing program, fiscal deficit numbers, or any of those. The government did 25% of their budgeted time, 25 to 33% of their time. This budget was made keeping in mind that there has been delay in the execution, right? Which means that the government is confident of doing double of what they did in H1 into H2. If that's the case, without government, we did 5.4%, which is right. It's very natural that with that extra thing and with festive season and everything, we we definitely should do 8.5 in Q H2, and that will meet our RBI guidance. And the earnings estimate will have to go up. And that's what we are playing. We believe, and there are traces of it. If you look at last 15, 20 days, the commentary from a lot of people who probably have access to data, the October, November data, which starts coming now, they have started saying that we could be in for a surprise. Something which I have been talking about for a long time. That don't look at these 2 quarters, look at the delayed because of what we have seen in the past. Hence, our portfolio is well positioned. What Senora, and which you pretty well know, what Senora aspires to deliver is stability with growth. Stability by having the right large caps in it, and growth by focusing on earnings system. The sectors where we are positioned is banking because banking and financials are the crux of a capex cycle because they lend the funding for it. We are playing manufacturing through cement, through power, and all the parameters related to that. We have a few indirect beneficiaries of the capex cycle, and yet we have the consumption play with the premium consumption coming. So it's a broad mix of the play around the growth and the capex cycle. We don't have IT because we are bearish on US economy and regulations around it in the US, not in India. We don't have pharma because I don't think we have the same understanding in pharma as our peers. We are better off without that. We don't want to play commodities because I think commodities is going to be very volatile and earnings could be very
Unpredictable
volatile.
behavior.
Yes. So barring that, we have all the levers of the economy in the including energy, power, and everything. But all because of large.
Superb. Just before we end, let me try and ask you one more question. Why are you so, obsessed is the wrong word, but stuck to the large caps and not venturing into mid and small cap?
I think obsessed will be the right word. I don't mind to be called obsessed for.
Okay.
So Maxi, let me ask you one question, and I think the answer lies in what you will say. I'll flip the the post here a bit. When you allocate money or request clients or advise clients to allocate a money to a manager, what are the parameters which matters? Returns, quality of returns, certainty of returns. Will these be the main weightages?
Absolutely.
Right.
And not to forget the risk.
Yes. So my probability of delivering return, and sorry, I will sound a bit aggressive here, or I can proudly say that in large caps, in the last 1 to 5 years, we have delivered much superior return than any of our peers. You have access to those data. You know what I am talking about. And that has come only by stock identification. So the return comes because of stock identification, right? Stock identification needs not only the financial understanding or the macro understanding, you need to understand and trust the company management and the promoter. Sitting here in my office, I don't have access to promote. We are too small a player for that. So I will always be behind the curve when it comes to a mid and a small cap. While in large cap, I will not be behind any fund manager because everything is in public domain. So my probability of going wrong in a large cap is only high if my knowledge is wrong and I'm confident on my knowledge. Whereas in the mid and small cap, my knowledge might be right, but yet I can go wrong for other factors. So that's why I'm obsessed for large cap. The second most reason why I'm obsessed for large cap is as an investor and as an asset allocator, what is the long-term return you expect from equity?
Want me to commit on that?
Yeah, just a range. Yes,
So
please.
I would say broadly, nominal GDP plus around, let's say, 2%.
Nifty delivers 1.5% of the nominal GDP. Sorry, the real GDP. The real GDP into 1.5 is the broader return of Nifty on a larger horizon. If I can give you 5% more than that, or let's say 2x of the GDP number
GDP
with a
number.
pure large cap strategy, I don't think you need anything else.
Yes.
And we have
Absolutely.
delivered that year after year, very patiently. So why to do something which is good? Why to try and change that?
Absolutely. Don't try and fix something which is not
Broken,
absolute.
right?
That's
So that's my strength. That's something which gives peace of mind to me and hence to my clients.
and absolutely the investors. So on that note, Mridul, I think I have come to end of my questions and what I want to hear from you. If you have something else to add, I would be happy to know.
So I want a perspective for my audience from a veteran like you, that so much noise is around valuations of market, like you said, market cap to GDP and stuff. I think a lot of the data, if looked at one step down, you'll find that the numbers are much better off. For example, while the market cap to GDP is definitely high from a historical mean perspective,
Yeah.
but there is a data, large caps proportion to the market cap is literally at all-time low
Okay.
or historical lows, while their in percentage contribution to the earnings of the market,
The profit pool is probably much higher.
yes,
Yeah.
which is why the PE of Nifty is roughly 22, while that of BSE 500 would be not a 30. So we need to demarcate the two.
Yeah.
And I'm sure you as an asset allocator do that.
Yes.
So,
Yes.
so
Absolutely.
my question to you is, what I believe is earnings in large cap will be a lot better in the coming 2 quarters.
Hmm.
Do you see money moving to equities if earnings come, even if the price moves up? Or do you think people will then again wait for a similar correction as we saw in October?
So I this is something which I practice myself, and I insist on my clients is that, as you said, underlying is your earnings. Then nothing else drives the price of the thing. If you don't have time, I do not encourage my clients to be in equity. And invariably, I push my clients to be biased towards large cap because that becomes my core portfolio. So I think clients would move to large cap. There's no doubt in my mind about it over the next 3 to 6 months. Unlike what happened historically, you actually can see money slowing down in mid and small cap to some extent. So that's broadly, and as you said, my primary job is not to become a fund manager. My primary job is to be a good asset allocator. It doesn't matter which asset class you're talking about. So if a client requires debt to be in his portfolio, I ensure that he has debt in his portfolio. I will not position a small cap or a mid cap or a large cap equity in a client who actually needs debt in his portfolio. My primary job is to get the asset allocation right, and my focus is completely on that.
Very well said, Maxi. Thank you.
You
And
know,
one last question. It's not a marketing question, but you are a stalwart, and we have known each other for a few years. For our audience, I will love if you can give a 1 2 minute summary of your experience with me and Chandora. Uh, we don't need to get into the details of how much we have worked together and stuff. Let that be off the record. But it was nearly 3 years back when we came to know each other through a common friend,
yes,
and since then we have been interacting.
absolutely.
While obviously you may end up talking only good things about me, but I want you to be very candid and honest feedback to the audience about what you feel about Senora.
So, Mridul, let me just, for me, you are synonymous to Senora. So my relationship is completely, with Mridul as an individual, in addition to just being a client, for you.
I'll just add one thing. Senora is in me and I'm in Senora. We both are same.
Exactly.
I don't have an identity outside Senora, so it's all Senora for me.
Absolutely. And I personally would, say that this introduction by a common friend of ours has been a very, very positive step, both as an investor as well as as an advisor, because I have proposed to have many more clients to work with you. I like the style you have. I like the core philosophy of focusing on earning, and I also like the obsession with large caps. And I think, without giving the numbers away, I think in last 3 years, whatever I've worked with you, we have beaten the index by a reasonable margin and much better risk-adjusted return than I would actually get from a mid or a small cap. And my allocation has moved to some extent. Large cap allocation has moved to some extent to you, and I would also, in future, have more clients invest with you and take the large cap allocation to their portfolios, to a portfolio like what you recommend for us. And it's done phenomenally well. I'm personally very happy. And without getting into technical details of it, you are a strong recommendation for me.
Thank you, Maxi. That endorsement matters a lot. And I hope that I can deliver to the faith of you and all the investors who are working with Senora. What gives us the confidence to do that is trying to be consistent and focus in the process. Because if you're right with that, results follow.
Absolutely. And wishing Senora all the best. May you
Thank you,
go
Maxi.
from strength to strength, and
Thank you.
look
I'm
forward
sure
to
with your
continue to
with
work with you.
support of friends like you, we will.
Thanks. Thank you very much.
Thank you,
Thanks.
Maxi.
Take care.